FinTech, or technology-enabled financial services, are becoming increasingly sophisticated as they evolve and scale around the world. FinTech is an area that's enormously promising for financial inclusion, but it is also a substantial challenge for regulators. Over the past 3 years, regulators in advanced, emerging, and developing economies have been working to adapt regulatory frameworks that support FinTech. These initiatives fall into 3 main categories: innovation offices, regulatory sandboxes, and Reg Tech for regulators. These initiatives are the focus of a report from FinTech Working Group of the UNSGSA and the University of Cambridge's Centre for Alternative Finance, with the support from the Monetary Authority of Singapore. A team of researchers interviewed over 40 regulators from more than 20 jurisdictions. They gathered empirical evidence to understand how regulators themselves are innovating to better respond to financial innovation. By sharing the experiences of national regulators, the goal is to accelerate empirical evidence and disseminate good FinTech practices globally. This framework shows how some regulators have responded to FinTech opportunities and challenges by innovating on their own. These initiatives aim to ensure that financial innovation strengthens regulatory policy objectives, including financial inclusion. They may also help mitigate negative impacts. This map shows where regulatory innovation activities are currently taking place. Globally, their reach spans Mexico, Abu Dhabi, Sierra Leone, Singapore, and beyond.
The first type of initiative discussed in the report is the Innovation Office. Innovation offices have different names, forms, and functions, but all engage with and provide regulatory clarification to financial services providers that seek to offer innovative products and services. They are often the first step in the regulator's innovation journey. There are currently more than 32 innovation offices around the world. 3 of these innovation offices have a specific financial inclusion mandate. Innovation offices promote financial inclusion by reducing costs for innovators and consumers. For example, the high cost of regulatory uncertainty has been highlighted in the United States, where some firms have delayed the launch of innovative products or not launched them at all. Innovation offices also improve consumer protections and inform policy making. In Hong Kong, the Securities and Futures Commission's FinTech office has helped innovators more efficiently develop compliant products by clarifying appropriate regulations. Regulators often prioritize working with providers that closely match their innovation office objectives. Eligibility criteria might include the promotion of financial inclusion, such as in Bahrain, Indonesia, and Malaysia. Regulatory sandboxes are the second type of initiative. These formal programs have been widely adopted, and they allow market players to test new products and services with live customers. However, they are still subject to regulatory safeguards and oversight. More than 50 jurisdictions currently have live or planned sandboxes. 9 of these sandboxes explicitly promote financial inclusion. Lessons learned from early sandboxes show that they're not necessary or even sufficient for regulating FinTech and promoting financial inclusion. Although they do offer benefits, they're complex to set up and costly to run. One regulator in an advanced economy had the equivalent of 10 full-time staff supporting the sandbox function. Another had just 1 full-time staff member running the sandbox, consequently resulting in constrained impact. Regulatory questions may be addressed more effectively through innovation offices and tools other than sandboxes. For example, a FinTech market landscaping study in Kenya revealed that an innovation office or hotline would go a long way in resolving regulatory questions of startups. Reg Tech for regulators is the third type of initiative. Reg Tech focuses on the best way to monitor and enforce compliance. Regulators use Reg Tech when they need to quickly respond to financial innovation. They also use it to protect consumers and enhance supervision. This encourages the growth of inclusive FinTech and helps bring about long-term regulatory transformation. Regulators are still in the early stages of adopting Reg Tech, and this report identifies 22 jurisdictions that are doing so. Lessons learned recommend beginning with a problem that has broad support and a high likelihood of resolution. For example, the Aadhaar Digital Identity Program in India was positioned to solve a number of problems felt across government, including social security fraud. Crowdsourcing solutions and strong executive sponsorship have also proven to be rewarding. The central bank in the Philippines, the BSP, provides a good example of executive sponsorship, with the leadership actively engaged both publicly and internally. It's also been found that multidisciplinary teams foster long-term regulatory transformation. For example, the US Digital Service seeks to recruit a wide variety of experts and skill sets as part of its digital transformation projects. Most of these innovative regulatory initiatives are still in the early stages of implementation, but it's clear that no single initiative is a silver bullet. The report also provides regulators with 10 implementation considerations. Among other points, the implementation considerations advise regulators to remain agile and open as they innovate. In the UK, the FCA has consistently sought to iterate and improve upon its various initiatives. Start small and experiment often to gain quick wins and gather momentum. In Mexico, the CNBV undertook small, quick experiments on Reg Tech to generate momentum and to gather valuable insights. Enable and promote a pro-innovation mindset and culture. This was universally recognised by the regulators interviewed as crucial.
Regulators have begun to benefit already from working together domestically and around the world. When regulatory initiatives are designed carefully and executed effectively, they can enable inclusive FinTech and support regulators in their long-term capacity building.